Every single investor, whether they're a seasoned pro on Wall Street or just getting their feet wet, is always, and I mean always, trying to answer two key questions. If you can get a handle on these, especially the first one, it will completely change the way you look at the market. So what are they? Let's dive in. You know how it is, right? You're at a barbecue or maybe just scrolling through social media and someone hits you with a can't miss stock tip. They sound so sure of themselves, and honestly, it sounds so easy. And that temptation is real. It feels like a secret shortcut, a fast track to making some quick money. But here's the thing. Acting on a tip without doing your own homework is basically like trying to navigate a maze with a blindfold on. Yeah, you might get lucky, but chances are you're going to hit a wall. Hard. And this brings us to the absolute core of it all. The most successful investors, they don't rely on luck. They don't rely on whispers or hot tips. They have a system, a repeatable, structured process that helps them cut through all the noise and make smart, informed decisions. So what is this system? Well, it's built on two main pillars, and each pillar is designed to answer one of those two crucial questions. The first question is, what company is worth my money? And the second is, when is the right time to actually buy or sell it? The what question is all about something called fundamental analysis. Think of yourself as a detective. You're digging deep into a company's health, checking its profits, its debt, who's running the show. The when question, that's answered by technical analysis, which is more about reading price charts and spotting market trends. Now, for this explainer, we are going to focus like a laser on that first question. How in the world do you figure out what makes a company a great investment? Okay, to make this all feel a bit less, financial, let's use an analogy. Finding the right stock is a lot like finding the best school for your child. Seriously, imagine that. There are thousands of schools out there. You wouldn't just close your eyes and point at one, right? Of course not. Well, the stock market is exactly the same. It's a massive universe filled with thousands of companies, all vying for your investment. So where do you even begin? You start with this huge universe of options. Your very first move is to filter them. You do a fundamental check. For a school, you look at its reputation, the quality of the teachers, test scores, the facilities. That's your fundamental analysis. It's only after you've found a handful of really great schools that you start thinking about the right time to enroll. That timing part, that's your technical analysis. It's all about narrowing down your options. So how do we actually do this fundamental check on a company? Good news, you don't need a PhD in finance. You just need a simple toolkit, a checklist of 5 key things to look at. Let's walk through them right now. First up is ROCE, which stands for Return on Capital Employed. All this number tells you is how good a company is at using all the money it has, that's its own money plus any money it has borrowed, to make a profit. A high ROCE, say over 15%, is a great sign. It's like finding a super efficient profit-making machine. Next, we have its close cousin, ROE, or Return on Equity. This one's a little more personal for us as investors. It zeroes in on just the money that shareholders like you have put into the company, and it asks a simple question. How good is the company at making a profit with our money? Just like ROCE, the higher, the better. Our third tool is the PE ratio, or price to earnings. This one is all about figuring out if a stock is a bargain or if it's overpriced. It answers the question, for every single dollar the company earns in profit, how many dollars are investors like us willing to pay for that share? Generally, a lower PE ratio, especially when you compare it to similar companies, means you might be getting a really good deal. Think about it like this. Which of these 2 bottles of oil is the better deal? At first glance, bottle B looks way cheaper. It's only $1. But when you do the math, you're actually paying $10 per liter. Bottle A with the bigger price tag is the real bargain. Stocks work the same way. A $100 stock can actually be cheaper than a $10 stock once you see what you're really getting for your money. All right, let's move on to tool number 4, book value. This one is your safety net. It's so important. Book value basically tells you what a company would be worth if it had to shut down tomorrow, sell off everything it owns, and pay back every single one of its debts. The money that's left over for shareholders, that's the book value. Just look at this example. Both companies have the exact same share price, $400, but they are not the same at all. Company A has a much higher book value, probably because it has way less debt. So in a worst-case shutdown scenario, you'd get back about $300 for your share. With Company B, you'd only get back $100. It's pretty clear. A higher book value gives you a much bigger cushion. And that leads us perfectly into our fifth and final tool, the PB ratio, or price to book. This ratio directly compares the stock's market price to that safety net we were just talking about. A low PB ratio is often a fantastic sign because it means you're paying a price that's much closer to the company's real underlying worth. You're not overpaying for hype. Okay, so you've got the toolkit, but to really use it well, you need to understand some of the lingo. Let's tackle the most important distinction in all of investing, the difference between price and value. Getting this right is a total game changer. Here's the deal. Market value is the price tag you see right now. It gets pushed around by daily news, by hype, by fear. But intrinsic value, that's what something is really worth. The goat analogy is perfect. The price of a goat might shoot through the roof right before a big festival because demand is crazy high. That's its market price. But its real intrinsic value is much lower, and you'll see that price come right back down after the festival ends. Smart investors are always looking for companies where the market price is below the intrinsic value. Two other terms that trip people up all the time are bonus shares and share splits. A bonus issue is exactly what it sounds like, a reward. The company gives you extra shares completely free, which actually increases the total value of what you own. A share split, on the other hand, is just financial paperwork. It's like taking a whole pizza and cutting it into more slices. You have more slices, but you still have the same amount of pizza. Your total investment value stays exactly the same. There's a great story about this. A company did a stock split, and its share price dropped from over 2,500 down to about 500, literally overnight. People were panicking. They were sending messages thinking they'd lost a ton of money. But they hadn't. Because it was a split, the total value of their investment was completely unchanged. See? Understanding this stuff can save you a lot of unnecessary panic. Okay, so we've covered a lot of ground. We've talked about why you need a system, we've built our fundamental analysis toolkit, and we've cleared up some of that confusing jargon. So let's pull it all together so you know what to do next. Here it is. This is your cheat sheet. When you're looking at a company, this is the combination you're hunting for. High ROCE and ROE, because that means it's profitable, a high book value, because that's your safety net, and a low PE and PB ratio, because that suggests you're getting it all at a fair price. And that is the real takeaway here. This is about a shift in your mindset. You don't have to chase hot tips anymore. With this simple framework, you now have the power to start doing your own research, to sift through those thousands of schools and find the genuinely high-quality companies all by yourself. This knowledge is your first real step towards becoming a more confident, more independent investor. It's about making that crucial shift from guessing to actually knowing. So the only question left is, are you ready to stop asking for tips and start doing your own analysis? Thanks for tuning in.